Hey guys, it's Chris Mincola with the Mincola Group over at West USA Realty, and we are doing our weekly market update. I'm going to jump right in here and share my screen with you. Hope everybody's doing well. Been kind of a crazy week here. Oops, got ahead of myself there. Um, Hope everybody's having a good week with everything that's going on. Let's just put it that way. Okay, so wholesale prices. I wanted to talk to you guys first about the inflation rate right now. Then we'll get into the jobs report because this is going to affect the 10-year Treasury, which affects mortgage rates. And that's a big component of what is going to be happening here as we move forward. So wholesale prices unexpectedly declined for the inflation rate for wholesale prices that for domestic product. So that was good news, but we had a little bit of an elevated CPI report. We had an adjusted increase of 0.4% for the month, the biggest gain since January, putting the annual inflation rate at 2.9%. Now, here's what I want to point out with this, okay? I always mention this, and I've been mentioning it for a very long time, way before the BLS person got fired and all that. And everybody in economics really knows this. The BLS uses super antiquated information. Uh, they have a lot of antiquated systems. A lot of the information gets revised as we go along, as we've seen, and we're going to talk more about here in a second. Um, but I think you're going to see a big shakeup there, and I think we're going to see some better data, hopefully, coming forward. But the point being is, I always track this chart here, and this is with Trueflation. Now, you can take it for what you want. Some people don't believe this, but if you go back and look at Trueflation charts, they actually track um, pretty close to 100% of the time. And the reason why their data is like the now inflation, which they're showing at 2.01%, and you're like, well, how can it be that? But the BLS is reporting 2.9 on CPI. And keep in mind, we'll be getting um, a report at the end of the month on the PCE, and that's a little bit more of what the Federal Reserve tracks. Okay. Um, so there's different inflation metrics. But anyway, this is a big report that people do track, and the Fed does take a look at it. But this core inflation rate is with Trueflation is more of right now. And what I mean is, if you go and look at CPI, the one of the biggest components of that, and I mentioned this before many times too in my talks here, 36% of CPI is shelter costs. What is that metric? They take basically surveyed rents, and they call people and do surveys, and they ask them, how much do you think your home that you own would rent out for? Now, a lot of people wouldn't even know how to answer that question. But that data lags 12 to 18 months. 12 to 18 months. Okay. So that is like, basically three quarters or a little bit more than three quarters of the entire data for that CPI report. So, and it's based on rents. They used to back in the day, look at other components of housing, but that's what they're looking at. So anyway, the reason why and Trueflation also takes even more data points in the economy, and that's how they come up with their numbers. And they put this out daily. And again, if you look on their charts and you can do your own research and check the reports that have come out, they track. They're just way ahead of what the BLS is putting out. So, and what you see on TV. A lot of times, and what we're looking at is year over year and how it, went down or up or down on inflation, with those reports. But again, that data can lag 12 to 18 months, as well as other components, not just shelter, but other things can lag too. But that's like the biggest. Okay. So again, don't have to take my word for it. Do your own research on that. But I think we're going to see in the coming months the tariff hysteria will die off. That if there is going to be a one-time thing, and companies are going to stop absorbing that, or people who are importing stuff are not going to renegotiate their deals, which a lot of them are doing on their wholesale raw materials and all that. That doesn't get hashed out, and there is an increase. It'll be a one-time increase, which is different than inflation. Inflation is too many dollars chasing too few goods. Okay. So, basically the government just prints too much money. And that's why we had the hyperinflation over the last few years. But in any case, and why, the Fed, we were screaming, the Fed need the lower rates. Back in 2021, they waited till, what was it, April or May of 2022. And, they were going heavy in on inflation, and we track inflation. We go along with inflation. I don't think he should have went, and neither does Logan Mohtashami and Barry Habib, which two of the best economists in the world, don't agree, that he should have went over four on the Fed's fund rate. Right now we're sitting at about 4.5. We should be more at a neutral stance at around 3 by many of their accounts. But now we're looking at their dual mandate for the Fed, and their policy, what they say, and the bond market's always ahead of them, but what they say drives the markets by 65%. 65 to 75% of what their policy is. And right now, they're calling it modestly restrictive. I think with the way things are, we should be more at a neutral policy. I think they're very restrictive. And they spiked the eggnog, as Logan Mohtashami puts it, at the end of 2022 for Jerome Powell. And he said, now we're going labor over inflation. So by Powell's own words, he's looking more heavily at the jobs numbers. And, another Fed president came out last week, and said that, I think we need to lower rates. We're having kind of a big, uproar in the Fed. We got the Lisa Cook case going on, and she was fired, and but she says she's not leaving, and she's doing her court cases and all that. We'll see how that all hashes out. They got a new Fed guy that they're supposed to be putting in for Kruger, who left, which makes you wonder why she left. Maybe she knew what was coming with some of this stuff. But in any case, they are looking at labor. So always think labor over inflation since the end of 2022, as far as their demand data is concerned. That's what they're focused in on. But these jobs numbers continue to prove that we have a weaker job market, like we've been saying for months and months and months. Payroll rose only 22,000 in August, less than expected, in further sign of hiring slowdown. So we've got a weaker jobs market. Unemployment rate is at 4.3. It was at one point, we thought 4.3 was going to be where they said that they were going to shift their policy. Then they moved the goalpost again from inflation to that to labor over inflation to 4.3. Then they said 4.5 would be fine. So we'll see how this goes. Everybody's expecting at least a 25 basis point cut. Some people are saying a poly market 50 point cut. Now with these jobs revisions, we had this huge jobs revision of 911,000. Remember, a few months back, we had another revision of almost 900,000 on top of this. So basically, almost 2 million jobs didn't exist. And when you look at the new jobs that have been added, a lot of them are just part-time work. The other issue is a leading indicator for a weak jobs market and right before a recession is you have your job losses in residential construction and continued job losses in residential construction of 6,100 jobs lost in August. Okay, so this puts us into 4, possibly going on 5 months of residential construction jobs, because you got the builders who are just like, hey, we're just not going to do a lot of building while these Fed rates are so high. Why? Because it costs them on the front and the back end. In other words, it costs them capital in order to get the lots, the land, okay, to fund those projects. And then they're offering all kinds of concessions and incentives to buy down rates. You can get a new home right now with interest rates at 3.9%. I've even seen 2.9%. Okay. Some of those are fixed, some of those are first year, and then it goes up and then stops at, like in the fives. You have to qualify for that higher amount if you're doing a 3-2-1 or a 2-1 buy down. That's meaning the number of years it increases and then stops at a fixed rate. So it's not like the 2008 crash market. Another thing is the arms. They aren't like back then. You have to qualify for the higher rate of where you're going to end up at. So, there's still that qualified mortgage thing. But, this is a big red flag for the Fed, for the economic sector. And that's why we saw what I'm going to talk about here in just a second with uh, the 10-year Treasury, which affects the mortgage rates. Also, one other thing we always track is manufacturing. We saw another loss of 78,000 year over year decline in manufacturing jobs. So, although we know that CapEx, which is all the materials that go into the AI projects and all the new technologies and basically the new economy that's coming our way, ramping up, those plants aren't built yet. Even the chips factory here, in Phoenix is going to take a while to ramp up, even though and we've got trillions of dollars coming in for all these new projects in technology and with car plants and appliances, you name it. They're all coming here now because of the tariffs, which eventually is going to be a good thing, but they haven't been built yet, right? And they're not going to be built overnight. It's going to take a couple more years to really get that ramped up. So, but the manufacturing and residential construction are huge, the two of the biggest ones you want to track because this is what the bond market's reacting to with these jobs numbers, and this is what could, historically has always led to recessions. Okay. And a lot of times you don't even find out you're in a recession for months after it's happened. On average, I think it's about 5 or 6 months typically. You don't even find out you were in a recession until months later. Again, all this stuff lags. So when you see these numbers, think, but some of this is lagging, and the shelter costs for rents have did come down and did level off. Okay, quite a bit. A lot of those projects that we had for all these multifamily homes, apartment complexes, and stuff. All those projects have slowed way down to a halt, pretty much. So the 10-year Treasury today ended up at 4. Now, typically, you've got about at the most historically a 2-point spread, 175 to 2-point spread. But right now, this is where we ended up at this lower level here. In order for us to get into the fives, we need to get below, 3.8. In order to get in the fours, we would need to be below 3 on a 10-year Treasury. Okay. Just to give you a quick idea there. Now, the mortgage rates, along with that, the 30-year fixed, this is the average across the country. If you go to one of our mortgage brokers, you're going to be in the fives today. Okay. Just out of the box. And then we can negotiate a buy down from most sellers right now because we're kind of in a buyer's market across the valley. I'll talk more about that in just a second. Here in the greater Phoenix area, we're in a buyer's market, so we can negotiate those rates down more for you. But out of the box, you'll be at the fives. But the average across the country is 6.9. So going back to this, we should be closer to 6, but the spreads over the last year have gotten much better. Right now, if the spreads were where they were about a year or 18 months ago, we would be near 7. So it's come a long way with the spread between the 10-year Treasury, or the spreads as we call them, and that 30-year fixed mortgage rate. Again, that'd be tracked on a conventional. Okay. And here are all your other loan types. Obviously, FHA is a little lower, and VA is always pretty low. So you you have this going on in home buyers since January. We had the biggest drop in 11 months just a few days ago on interest rates. Okay, the biggest one day drop in 11 months. which was, great for the market. And we always track this and we say, if we get below 6.4, we know that whenever we get to 6.4 or lower, we see a surge in the market with buyer applications. Okay. The issue's been we haven't stayed there for a sustained period of time. 12 to 18 months is usually, would be a sustained period of time, or lower, obviously. So looking ahead, Logan Monashami put these numbers out. Purchase application data is updated. So +7 week to week. That's a big jump. Again, we're working off some of the lowest levels, but plus 23%. These are people who've applied for home loans. Now, some of them are sellers too, so they have to sell their house first. Okay, in a lot of cases, but these are people who've applied for home loan pre-approvals. You got to get pre-approved to buy a home today, unless you're paying all cash and you have proof of funds. Your seller or builder is going to want to see how you paying for this, basically. So plus 23% year over year. That's huge. The weekly data for 2025 so far: 17 positive readings, 12 negative, 6 flat prints, 32 straight weeks of positive year over year data. That's great. Here's the chart below: 19 consecutive weeks of double digit growth year over year. So forward looking, that tells us 30 to 90 days. That's a pretty good outlook, especially in the second half of the year. And as rates go lower, we'll have to see, are we, getting more inventory because sellers are like, yay, now I'm going to put my home back on the market, maybe if it didn't sell before, or, more buyers coming in the market. For every 100 basis point or 1% drop, it's pretty well stated that not that they will, but that 5 million more people could potentially enter the market if you have a 1% drop. Now, we were just near this at 7 not very long ago. Okay. So we'll keep an eye on these and track this every week. Now, as far as our supply is concerned, and purchasing power is, because of that, is also increased 7,500 in the last week alone, with the rates falling to that 6.29 level. On a week, just with this jobs report that came out. Now, overall, we've got 24,000 homes for sale. If we just look at single family homes, that number drops to just over 18,000 for single family detached homes. Okay. So the housing supply compared to last year, it's gone up 6.4% compared to September of 2023. It's up 29%. So we've got more inventory out there, which has kind of put us in this buyer market situation. If we look at these charts real quick, we've got 84 closed days on market is the average here in the greater Phoenix area, 5.5 month supply. So this puts us kind of more for us in a buyer's market. And then absorption rate, 18%. That's definitely a little low of what's being absorbed. The average list price is 708. The average sales price is 584. And the list to sales price ratio is 97.17%. Usually we like to see that just over 98% is kind of more normal for us. But with the elevated rates and the extra inventory, it kind of sways a little bit more to buyers. People are lowering prices or they're offering concessions. We'll see how that holds as rates drop and maybe inventory weakens a little bit more towards this year. I think you'll see more people who wanted to sell try and put their home back on the market though. So we'll track that and see how it goes. Active inventory up 1.1% from last week. And that gives us the supply. Now, these numbers were taken on the 8th, but the pending sales is down 5.2%. And the closed units is up 14.7%. So that's a huge jump there. By the way, the number of homeowners, homeowner households actually fell 0.1% year over year in the second quarter. Again, just looking back there a little bit, and then a small decline, but the first since 2016. The number of renter households rose 2.6%, and that's one of the biggest increases in the most recent years. So just food for thought there. But again, as rates drop, I think we're going to see more homes come on the market, but we're also going to see more buyer demand. So we'll see. I think we're just headed towards a more balanced market here soon. I'll show you that in a minute. Um, the so the closed units are up, and these are all the price ranges right now. The biggest price range is the 400 to 600,000 range here in the Greater Phoenix area. The uh, the luxury market up over 1 million, is the lowest percentage, obviously. And we see the days on market right here for the different different price brackets. You can take a look at that right now. The average price range right now is running at about 84 days on market. So for the valley, for that average range right now, the average across the country is about a $450,000 home. So next, this is what we call the Cromford Market Index. They're the local gurus who kind of track everything for us. And this is the latest number here. This index was in the 70s. And every week it's ticked up. I think we're heading towards a more balanced market, but 90 to 110 is a balanced range, 100 being totally balanced. If demand and supply are both the same, these numbers here on the ends, if they're both the same, then we're completely at 100. Below 90 is a buyer's market, which we're in right now at 81. And over 110, we head into a seller range. So we can see um, supply is definitely ticking up a little bit, and we see our demand has also come up just a hair. Okay, so we track this every week, and to get a little bit more in depth here on this, um, the Paradise Valley right now, if we look at the actual map, Paradise Valley is in a seller's market. It's actually down 7% from last week. Uh, the Fountain Hills area, Scottsdale, Chandler, Cave Creek, Avondale, and uh, let's see, in Avondale, yeah, those six, those are all technically in seller markets. So if you're in those areas, that's where you are. Gilbert, Phoenix, Glendale, and Mesa, they're in balanced markets. So no advantage to the buyer or seller, just kind of balance, sitting there in the balance range. Um, but all these cities that I talked about, they're actually heading upwards again, um, towards more, in the direction of seller. And then our buyers markets are Peoria, Tempe, Goodyear, Surprise, Queen Creek, Buckeye, and Maricopa City. So we look on the map here, just going back to this map here really quick. You can see um, this right here, what's under contract and what's active right now. This is our contract ratio. This is even more like right now, here's where we are right now. The overall, we're in a warm range, just barely in a warm market. Okay. So we're sitting at 32 on the contract ratio. So just over 30, it puts us in a warm market. So we're moving again a little bit more towards that balance range, looking at what's under contract and what's active. And these are the areas right now that kind of give us a little bit more of a hotter. So looking at the right now, we look at the Phoenix area 85037 and 85310. Those are in hot areas right now. If those are your zip codes, and also in Mesa, that's also another hot area with the contract ratios, what's under contract, what's active. If you look at everything else, it's kind of cold to warmer balanced. Okay. So the next Fed meeting, and keep in mind, it's what the Fed does, what their policy is, makes up 65 to 75% of what the bond market does, but the bond market always reacts first. So the bond market, they've already priced in 25 to 50 basis point cut. So if you see the Fed next week, it's going to be 16th and 17th is when they meet. If you see 25 basis point come out next week, it's probably not going to move the market that much. And a lot of people are going to be scratching their head with like, I thought they were. Well, remember, the Fed rate isn't 1 to 1 with the mortgage rates, but the policy of the Fed, what they're going to say, about the market, and they have nowhere to hide now with these jobs numbers, with labor over inflation. Uh, you know, they have to, basically they have to do a 25 basis point cut at least. Again, some people are saying 50. Would 50 move it? Maybe a little bit. Anything over that, by the end of the year, we may see another cut by the end of the year, possibly two, depending on how good or bad the labor numbers do, and obviously the secondary to that, the inflation rate. So we'll keep an eye on things. If you have any questions at all, please feel free to reach out to me anytime. If you need any searches put together, have any more questions about your specific area, home evaluation, if you're interested in buy down rates, what that means, assumable loans, anything like that, please reach out to us. We've got a great mortgage broker we work with, and we could certainly help you with any questions at all. Be sure to like, follow us, share us with somebody who may find this information helpful, and we'll see you next time. Thanks.